Hi students, I hope you are all well. Welcome to the third video on valuations. In this video, we'll be focusing on the free cash flow valuation models. As you should remember from your undergraduate studies, there are two possible approaches. Either we can use the enterprise or entity approach. This is an indirect equity valuation. What this means is that if we use the enterprise or entity approach, we are actually valuing the enterprise or entity. Then, to get to the value of equity, we will have to subtract the value of debt. If we use the equity approach, this is a direct valuation as it directly values equity. So let's first have a look at the enterprise approach. The first thing I need to tell you about this approach is that it is most commonly used in practice. It is more frequently used than the equity approach. However, the equity approach can be used to value highly leveraged firms or for valuing financial institutions. Let's have a look at the enterprise approach. How will we get to the value of equity using this method? Now remember I said the way we value something in corporate finance is by determining its future cash flows and present valuing those future cash flows. So the first thing we need to do when using the enterprise approach, we need to value the operating assets. And we are going to do that by forecasting the future cash flows of those operating assets and then present valuing those cash flows. Once we have the value of the operating assets, we then need to determine which assets are non-operating assets. So often there will be two types of assets in a company. Those that form part of the operations and are used to generate operating income like revenue. Or a company will also have non-operating assets. This is something like investment property or a fixed deposit at a bank that is earning interest income that does not form part of the operations of the company. The reason these need to be valued separately is that often the operations of the company have a different risk profile to the investing activities of a company. So these actually need to be valued separately. So once we have valued the operating assets, we then need to value the non-operating assets. When valuing the non-operating assets, it is important to use the market value of these assets, if they are available. Once we have valued the operating assets and the non-operating assets, this will give us the enterprise value. This is basically the value of all of the assets in the company. But our aim here is actually to value equity. So how are we going to get from the enterprise value to the value of equity? We will have to minus the market value of debt. Often you will have to determine the market value of debt based on the information given to you in the question. However, if there is no information given to you in the question on how to determine the market value, then you will have to assume that the book value is equal to the market value. So just to reiterate, the first step in performing the enterprise free cash flow model is to value the operating assets. And I said that the way we value the operating assets is by forecasting the enterprise free cash flows. Once we have forecast the enterprise free cash flows of the operating assets, because these cash flows occur in the future and we are trying to value the operating assets today, we need to discount these forecast enterprise free cash flows. And because we are using the enterprise free cash flow model, we will discount these forecast cash flows at the firm's cost of capital. The enterprise free cash flow is based on the same growth assumptions as the dividend discount model. So at some stage, growth is expected to be constant into infinity. So there will be two stages to this model. If there is a period of non-constant growth in the enterprise free cash flows, this will be known as the explicit or planning period. We need to split our model in two. So the first thing we need to do is to determine the present value of the enterprise free cash flows during the explicit period. During the explicit period, the growth in your cash flows is not constant. Therefore, each year, the growth in these cash flows is going to be different. So we need to present value the enterprise free cash flows every year during the explicit period, as the growth rate is not constant. At some time in the future, growth rate will be said to be constant. At this point, into the foreseeable future, the growth rate will be constant. And we need to determine the value of this. And we will do this by determining something called the terminal value. Once we have calculated the terminal value, we need to present value this terminal value, because the terminal value is representing the value of the future cash flows into infinity at some time in the future, but we want the value of the terminal value today. So we will present value the terminal value. Once we have determined the present value of the enterprise free cash flows per annum during the planning period, and we have determined the present value of the terminal value, the sum of these two items will give us the present value of the operating assets. So how are we going to calculate our terminal value? We will calculate our terminal value using the formula in this slide. So if we assume we have an explicit period or planning period, which is for 5 years, during this period, growth is not going to be constant. But at the end of this 5-year period, the growth rate will be constant. At this point, we can calculate the terminal value. So the terminal value at the end of period 5 will be calculated by taking the enterprise free cash flows for period 6 divided by WACC, being your weighted average cost of capital, minus G. So once we have determined the terminal value at the end of the explicit period, which in this scenario is at the end of 5 years, we need to present value this terminal value. This terminal value is the value at the end of 5 years, but we want to know what is the value today. So we are going to present value the terminal value, and we are going to do this by dividing the terminal value, which we got using the previous formula, divided by 1 plus WACC to the power of 5, because we are present valuing it back 5 years. G represents the constant growth rate in the enterprise free cash flows into perpetuity. How will we determine the growth rate? We will determine the growth rate just like we did for the dividend discount model. Please take note that the free cash flow valuation is very sensitive to the growth rate. So when the growth rate is being calculated or decided upon, it is very important to apply sensitivity analysis. If our growth rate is inaccurate by just 1%, it will cause a huge change in the terminal value and hence a huge change in the value of equity. If we have a situation where the constant growth rate expected by a company is greater than the GDP or CPI, we need to ask ourselves, will this growth rate be maintained? Often there are certain industries where there is a high growth rate, and the reason for this is that new companies are prevented from entering the industry because there are certain barriers to entry. You can see from the formula here that the value of operating assets today is the enterprise free cash flows at the end of period 1 divided by WACC minus G. And this is conceptually similar to the dividend discount model that I mentioned previously. In the dividend discount model, you will have the value of the share today equals D1, the dividend at the end of period 1, divided by your cost of equity minus G. So this is conceptually similar to the dividend discount model. What format will your enterprise free cash flow take? This is an example of the basic format which your enterprise free cash flow valuation could resemble. Remember, the enterprise valuation is based on forecast cash flows. So our starting point can be forecast EBIT, being your earnings before interest and tax. Why are we starting here with our EBIT and not our net operating profit after tax? When you are performing an enterprise free cash flow valuation, because you are discounting your cash flows using the WACC, it is not appropriate to subtract the interest expense in your free cash flows. So if you think about what the weighted average cost of capital is made up of, it is made up of your cost of debt and your cost of equity in weighted proportions to the market value of those items in your business. So because we are accounting for the cost of debt in your WACC, being your discount rate, it is not appropriate to subtract your interest expense when you are calculating your cash flows. So what you'll see here is that we start with our forecast earnings before interest and tax. We are not subtracting our interest expense because we have already accounted for this risk in the WACC. Remember, we are performing a cash flow valuation here. So do you agree that a company needs to pay tax? Tax is actually a cash outflow for the company. So we need to calculate what is the tax on our earnings before interest and tax, and we need to subtract this when calculating our enterprise free cash flow valuation. This will give us our net operating profit after tax. Included in the net operating profit after tax are certain accounting adjustments like depreciation and amortization. The depreciation and amortization are not cash flows. These are simply accounting adjustments made. Remember, we are performing a cash flow valuation, so all non-cash flow items need to be stripped out. So because depreciation and amortization would have been subtracted when calculating the earnings before interest and tax, we need to add back any depreciation that was subtracted and add back any amortization that was subtracted. The next item we need to adjust for is changes in our net working capital. When a company increases the working capital balance, this will result in a cash outflow. When a company has a decreasing net working capital balance between different periods, cash is being released into the company, and this will result in a cash inflow. So you need to calculate the changes or movements in your net working capital balance year on year to determine whether your movements in working capital are cash inflows and outflows, and these need to be taken into account in your enterprise free cash flow. We also need to take into account any fixed asset acquisitions and disposals. So when there is a fixed asset acquisition, this is going to result in a cash outflow. And when there are disposals of assets, the proceeds on those disposals will result in a cash inflow. Once we have taken all of these amounts into account and adjusted our EBIT for this, we will be left with our enterprise free cash flow. This figure will represent the operating cash available for debt and equity providers without compromising ongoing operations. So once we have determined the enterprise free cash flows for every year in the planning period, we will present value this. And then we will obviously have to calculate the present value of the terminal value as well and add this together. Another thing I need to mention is that if a company has investments and these investments do not form part of the operations of the company, any interest or income relating to those investments will also need to be stripped out of the enterprise free cash flow. And the reason for this is that we are going to value these investments separately. So the investment income relating to those investments cannot be included in the operating cash flows because they are not operating in nature. So it is important when you're doing a question on valuations, are they telling you that the investment is relating to operations or that it is separate and relates to investment activities only? Make sure you're looking in the scenario to glean this important information. Now that we have looked at the enterprise free cash flow, we can look at the free cash flow to equity approach. Just like the enterprise free cash flow was an indirect valuation method, which means we get to the value of equity indirectly because we valued the enterprise, then we had to subtract the market value of debt to get to the equity value. When we use the free cash flow to equity approach, this is a direct valuation method in that we are valuing equity directly. So to calculate the value of equity using the free cash flow to equity approach, we will present value the free cash flows available to the shareholders, being the equity providers. Then we will add the value of the non-operating assets. Remember, non-operating assets are things like investments. So remember, our free cash flow to equity, this is surplus cash that is available to the equity holders. We can calculate this by using a template similar to the one below. So here they are starting with forecast net profit after tax, and they have told you that it is after interest paid but before investment income. So when we were doing the enterprise approach, we said those cash flows are going to be discounted at the WACC. And because the WACC includes the cost of debt, we do not need to subtract the interest expense when we are looking at the enterprise approach. But this is the equity approach, so these cash flows will be discounted using the cost of equity. The cost of equity does not take into account the financial risk. Therefore, we need to subtract the interest paid when we are determining the value of equity using the equity approach. Again, we will not include any investment income that relates to those investments because those are not forming part of the operating cash flows. Then we need to take into account all of the non-cash flow items, things like depreciation and amortization. These adjustments were made by the accountant, but it did not result in a cash outflow. They are merely accounting adjustments. So if depreciation and amortization was subtracted in calculating the net profit after tax, we need to add these back. Then we also need to take into account changes in net working capital. So just like we did for the enterprise approach, any movement in the working capital balance will result in a cash inflow or cash outflow depending on whether the working capital balance is increasing or decreasing. Then we also need to take into account any fixed asset acquisitions and disposals. Obviously, a fixed asset acquisition is going to result in a cash outflow, and a disposal of an asset will result in the proceeds on the disposal, which will be a cash inflow. So because we are valuing equity directly, we need to take into account any change in debt financing that occurred. And we will do this by looking at the opening balance of debt and the closing balance of debt. And any change in the debt balance will result in a cash outflow or cash inflow, depending on whether the balance increased or decreased. If we take all of those adjustments to net profit after tax into account, this will give us the free cash flows to equity. Once we have determined our free cash flows to equity, these are going to be future free cash flows, meaning these cash flows will happen at some time in the future, but we want to know the value today, so we need to present value these future cash flows, and because we are using the equity approach, we are going to discount them using the cost of equity. And just like we had a two-stage model in the enterprise approach, we will have something similar in the equity approach. During the first 5 to 10 years, growth may not be constant. So we will have to value each of these years separately where the growth is not going to be constant. At some stage in the future, growth will be assumed to be constant into infinity. At this stage in the future, you can calculate the terminal value. This terminal value will have to be present valued. And you can see from the formula provided that this is conceptually similar to the dividend discount model. So remember, the dividend discount model, the value of the share was calculated by taking D1, being the dividend at the end of year 1, divided by your cost of equity minus G. And here we are calculating the value of equity. And the value of equity today is going to be your free cash flows at the end of period 1 divided by your cost of equity minus G. So please make sure you know the difference between the enterprise approach and the equity approach, and that you don't confuse the two in a test or exam. If we are valuing unlisted equity using the free cash flow valuations method, we may come across a few problems. If we are using the free cash flow to the firm approach for unlisted equity, we will need to discount the cash flows using the weighted average cost of capital. Remember, your WACC comprises your cost of debt and your cost of equity. If we think about the cost of debt, can we determine the cost of debt for an unlisted company? Yes, usually we can. The company is already likely to have bank debt at a variable rate. So we can determine the cost of debt by looking at any debt the company has from the bank and by using the variable rate of that debt. So it is not difficult to determine the cost of debt in this case. But how will we determine the cost of equity? And this can give us more problems. So how do we determine the cost of equity? Remember, we can calculate the cost of equity by using the capital asset pricing model or by using the dividend discount model. If we use the capital asset pricing model, we need to have a beta, and an unlisted company doesn't have a beta. If we want to determine the cost of equity using the dividend discount model, we then need to know the market price of the share. And if we are trying to determine this for unlisted equity, there may not be a market price available because these shares are not listed. So it can be very problematic to determine the cost of equity. So often what you'll find in practice is that if we are trying to determine the cost of equity for an unlisted company, often the beta of a similar listed company will be obtained, and this can be used as a starting point to estimate the cost of equity of the unlisted company. But remember, if we are using the cost of equity of a listed company to value an unlisted company, there are going to be differences in the financial risk and business risk between the listed company and the unlisted company. So just like we made adjustments to the PE multiple method, certain adjustments can be made to the cost of equity if we are using the beta of a listed company to determine the cost of equity of an unlisted company. Certain adjustments that can be made when you are adjusting the beta of a listed company to determine the cost of equity for an unlisted company, you will discount for the fact that the listed shares are more marketable than the unlisted shares. So we are going to discount for the degree of lack of marketability. We can also make an adjustment if the listed company is larger than the unlisted company. Often unlisted companies will be smaller than their listed counterparts. If this is the case, then we will need to adjust to take into account that the companies are different sizes. There could also be specific risks between the listed company and the unlisted company that need to be adjusted for. So how will we adjust for any of these risk factors in a free cash flow valuation? So we could make an adjustment to the cost of equity so that when we are discounting our cash flows by the cost of equity, if we add a premium to the cost of equity, this would usually reflect that these cash flows are more risky for the unlisted company, and therefore we would get a lower value. So if a company did not make an adjustment to its cost of equity, it could make an adjustment to the estimated value of equity at the end. So if we are discounting for the lack of marketability, in the past, analysts have discounted the value of equity at the same percentage as we did previously for the PE multiple. If we want to adjust for the fact that our unlisted company is smaller than our listed company, we could add a premium to our cost of equity. In the past, companies have adjusted on average of between 2 and 7%, and they have added a premium to their cost of equity. If there are specific risk factors that make the unlisted company more risky than the listed company, you can also add a premium to the cost of equity. In the past, a premium has been added to the cost of equity of between 2 and 7%. So if we look at the ITC source, they recognize the possibility of adjusting the cost of equity as we have just mentioned above. However, no percentage seems to be given. So instead, the approach the ITC has followed in the past is that the estimated values are discounted. So the equity value can be adjusted, and the adjustments they seem to make are in line with the adjustments we discussed under the PE multiple method. As you are writing the ITC exam next year, it is advisable to follow the approach they have used in the past. There is professional judgment involved, but if you follow the approach they have used in the past within reason and taking into account all of the information they give you in the question, you are more likely to come out with an accurate equity value. This is the end of the third and final video on valuations. If you did not watch video 1 and 2, I strongly recommend that you watch these videos before performing your tutorials, as this will give you further guidance on how to answer your tutorial questions. Thank you and goodbye.